So you built a business, but no one ever talked to you about whether you should be incorporated or a sole proprietor, or even what the difference actually is. My name's Nicole. I am a dual licensed CPA, and let me tell you, you are not behind. And let's walk through this together with examples. So to start, a sole proprietorship is you and you are the business. There's no separation between the business and you and the business. This means for both legal and tax purposes, you're considered to be the same entity, the same person. So let's use Sarah as an example. Let's say Sarah is a content creator and she is working with a client who maybe isn't happy with the way that she represented their company on social media. If that client sues Sarah and she is operating as a sole proprietor, this means that they are going to sue her personally, which means that her personal bank accounts, her car, her home could be at risk in this lawsuit. So they're not suing Sarah's business, they're suing her. And then from a tax perspective, it's very similar. So there's no separation between you and the business, which means that you are taxed as one unit. So all of the income that you are earning in your business is taxable to you personally in that year. So using our Sarah example, let's say that she does content creation as a side hustle. Maybe she has a full-time job as an accountant, for instance. So Sarah gets to the end of the year. She's had a very successful content creation year. She made $120,000 creating content. This means that on her personal tax return, she has to report all of her accounting employment income as well as all of that content creation business income. And that could push her into a really high tax rate because personally she's taxed in the tax brackets at the graduated rates. In BC, at the time of filming, the highest bracket I think was around 53%. So that's obviously a very high tax rate. Then she would be taxed on that personally every single year that she is a sole proprietor. She obviously can deduct her business expenses if she has any, but the overall takeaway is that her and her business are taxed together as one person on her personal tax return, her T1. On the other hand, when you are incorporated, the corporation that you set up is its own legal entity. So you are completely separate for legal and tax purposes from the corporation. So legally, this means that if Sarah had her dispute with this client that's not happy with the work, and they sued Sarah, they're actually suing Sarah's company, which means that as part of this lawsuit, they can only access the assets that are in the company. So her personal car and her savings account and maybe her home are no longer exposed because those are her personal assets, not the corporate assets. Things that might be exposed are, like cash in the company and any other assets that the company might own. These are what the creditors can get at. So we call that creditor protection when you want to set up a corporation for legal purposes. The other side of this is the tax aspect. So when you are incorporated, the company itself is taxed on its own income on its own tax return. So that $120,000 that we talked about Sarah earning this year would be taxed in the corporation on its T2. And one of the major benefits here is that corporations are taxed at a much lower rate than you are personally, especially so most companies that are newly incorporated in BC, most companies in general, I guess, are something called a CCPC, which is a Canadian controlled private corporation. And CCPCs are eligible for a 11% tax rate on their first $500,000. And you can contrast that to the graduated rates, the tax brackets that we just talked about, where she might be taxed near 50% on that income. So that's a big difference. The corporation is taxed on its profit. So it's revenue less its expenses, or it's sales less any expenses. And if Sarah needed to take any money out of the company, she would have that $120,000 of revenue that she earned. Say she needed 80 of it to live off of, then that 40 that's left in the corporation, that's only taxed at 11%. And this is what we call tax deferral that wasn't available to her when she was a sole proprietor versus now when she's incorporated. That 40,000 after tax can be left in the company to be invested or invested back into her business. But the honest trade-off is that incorporation isn't automatic, nor is it free. So there's going to be a lot more admin and costs that come with incorporating. So, for instance, the incorporation itself can cost around $1,000 for a law firm to do it. There is also ongoing legal costs that are or legal work that's required to be done every year to maintain the company in good standing. So there's legal documents that need to be filled out and filed with the registry and the associated costs with that. And then there's also the tax aspect. If you're comfortable doing the corporation's T2 on your own, then maybe you don't have to pay for it. But most people would pay an accountant to do their corporate tax return. So that's an additional cost. There's also bookkeeping that should be done really under both circumstances, whether you're a sole proprietor or whether you're incorporated. But it's, I would say, more important for a corporation, especially if you are going to hand that off to an accountant at the end of the year, because they need books to work from to be able to complete your tax return. So there's a significantly higher admin and compliance burden with being incorporated, and the costs and the complexity are obviously much higher, because you could go out today and start a sole proprietorship. You could go out and get a client and earn some income and maybe deduct some expenses from that without setting anything up. It's very easy, it's simple, it's quick. So the real difference as a sole proprietor is that you and the business are one. You are one legal entity, you are taxed together, and you are exposed together. When you are incorporated, you are two separate legal people, taxed separately, and there's basically a wall between you, so creditors can't access your personal assets. So which option is right for you isn't based on ambition. It's based on how much surplus is going to be left in the business and the risk environment that your business is operating in. If you are in a riskier industry, you might want to think about incorporating sooner. If you're in a less risky industry, maybe not as important. But if you're wondering when is the time to incorporate, that is the next video. Thanks so much for following along. Let me know in the comments what other topics you want me to cover, and subscribe and follow along for more.